Now, how many of you have ever been on a date that started out great, but then suddenly took a nosedive when the context changed? It's similar to managing commercial real estate investments when interest rate fluctuates. Welcome back to ECMP Studios. I'm Amit Grover, and today we're tackling how changing interest rates can impact your equity yield and what strategies you can employ to stay ahead. Interest rates are pivotal in the real estate market. Much like the ambiance in a restaurant that can affect your dining experience, they directly influence your financing costs and consequently the profitability of your investments. When interest rates rise, borrowing costs go up, which can squeeze your profit margins if you're relying on financing for your purchases. This shift can challenge investors to rethink their strategy to either maintain or enhance their returns. Equity yield, which measures the return on the equity portion of your investment, is particularly sensitive to these changes. Here's the crux. As interest rates increase, the cost of debt rises, and unless the income from your properties keeps pace, your equity yield could diminish. Conversely, when interest rates fall, it can lead to lower financing costs and potentially higher equity yields, assuming your property income remains stable. To navigate this dynamic landscape, savvy investors monitor interest rate trends very closely and they adapt their strategies accordingly. For instance, locking in fixed rate mortgages during periods of low interest rates can protect you from future increases and stabilize your equity yield over time. It's also wise to consider refinancing existing loans if the interest rate climate becomes favorable. Consider this scenario. You own a commercial property financed with a variable rate loan. As the rate climbs, your financing cost increases, reducing your net income, thus your equity yield. By understanding this relationship, you could proactively seek to refinance your loan under more advantageous terms, securing a fixed rate mortgage that offers predictable cost and helps you preserve your investment's profitability. Now, I invite you to think about your current investments. How exposed are they to these fluctuations? Are you positioned to handle a rise in interest rates? Or do you really need to reconsider your financing strategy? Engage with us in the comments below, sharing both your thoughts and strategies. In our upcoming episode, we will break down cash flow, tax savings, and loan amortization. If you're looking to understand the finer details of how cash flow operates within your investments and how to make the most out of tax benefits and loan structures, you definitely don't want to miss out. Make sure to like, subscribe, and turn on notifications to stay updated with the latest from ECMP Studios. Let's keep learning, keep planning, and as always, keep it real. Stay